Every morning at 11 a.m. in London, a number is calculated. You've probably never heard of it. It's called Libor, the London Interbank Offered Rate. And for decades, it quietly determined the interest rate on your mortgage, your student loan, your car payment. It underpinned $350 trillion in financial contracts worldwide. It was the single most important number in global finance. Between 2003 and 2012, the world's biggest banks were secretly rigging it. They paid fines, nobody went to prison. The number is still used today. This is the $200 billion fraud nobody went to jail for. Here's how Libor was supposed to work. Every morning, a panel of the world's largest banks, Barclays, Deutsche Bank, UBS, JP Morgan, Citigroup, the Royal Bank of Scotland, submitted an estimate. The question they were answering was simple: at what interest rate could your bank borrow money from other banks today? Thomson Reuters collected all the submissions, threw out the highest and lowest 25%, and averaged the rest. That average became Libor, published every day at noon London time. The idea was that no single bank could manipulate the rate, because the extreme submissions got cut. If one bank lied, the trimming process would filter it out. There was one problem. Nobody checked whether the submissions were true. The banks weren't required to prove their numbers with actual transactions. They just had to submit an estimate. An opinion, a number they made up every morning. And for 9 years, they made up numbers that made them money. The mechanics of the fraud were embarrassingly simple. A derivatives trader at Barclays had a position, a bet, that would pay off if Libor went up or down a fraction of a percentage point. So he sent an email to the colleague who submitted the bank's daily Libor estimate. The emails, which became evidence in court, read like they were written by people who felt completely untouchable. Can we have a high Libor today? Sure, no problem. Dude, I owe you a big favor. Pleasure. That's it, that's the fraud. A trader asked for a number. A submitter changed the number. Hundreds of trillions of dollars in financial contracts shifted accordingly. Barclays alone made 257 documented attempts to manipulate Libor between 2005 and 2009. Deutsche Bank, UBS, the Royal Bank of Scotland, HSBC, Rabobank, at least 16 major global banks were eventually implicated. Traders at different banks were coordinating with each other, aligning their submissions, moving the rate together, splitting the profits. They called it making a few pennies. Across $350 trillion in contracts, a few pennies per dollar adds up to somewhere between $150 and $200 billion in redirected money. And regulators knew. By 2007, the New York Federal Reserve had received a memo from a Barclays employee flagging that Libor submissions were false. In 2008, then New York Fed President Timothy Geithner sent a memo to the Bank of England recommending reforms to the Libor process. The Bank of England took note. Regulators on both sides of the Atlantic were aware that the most important benchmark rate in global finance was being manipulated. Nothing happened for 4 more years. Here's what makes this different from a victimless financial crime. Libor wasn't just a number that banks traded against. It was the rate that determined what ordinary people paid on loans, and what ordinary investors received on savings. When the banks suppressed Libor artificially low during the financial crisis, pension funds received less in interest payments than they were owed. Cities and municipalities that had entered into interest rate swap agreements, financial products that were supposed to protect them from rate volatility, received lower payments than the contracts promised. The city of Baltimore filed suit. A public employee pension fund in Connecticut filed suit. The Federal Deposit Insurance Corporation filed suit on behalf of 38 banks that had gone bankrupt during the crisis, arguing their losses were compounded by the manipulation. One analysis estimated that a family with a $100,000 adjustable rate mortgage was paying $50 to $100 more per month during periods when Libor was being manipulated upward, before the crisis, when traders were pushing it high to profit on derivatives positions. Across 100 million mortgaged families. For several years. The numbers become almost impossible to process. Municipalities lost at least $6 billion in fraudulent interest payments. That's $6 billion out of public school budgets, road repairs, fire departments, pension obligations, redirected to bank trading desks.
The person who felt this wasn't a derivatives trader. It was a pensioner in Connecticut whose retirement fund received less every month than it was contractually owed. It was a city budget manager in Baltimore who couldn't figure out why the math kept coming out wrong. They never knew why. Because the fraud was invisible. Built into a number they'd never heard of. In June 2012, Barclays became the first bank to formally admit to manipulating Libor. They paid a fine of $450 million. The markets shrugged. Barclays CEO Bob Diamond resigned, but left with a severance package. Then the dominoes fell. UBS, $1.5 billion fine. Royal Bank of Scotland, $612 million. Deutsche Bank, $2.5 billion, the largest fine in the history of the scandal. Rabobank, HSBC, JP Morgan, Citigroup, Bank of America. Total fines across all institutions, approximately $9 billion. $9 billion sounds enormous. It is enormous. It is also, give or take, 6 weeks of profits for the banking industry. It was paid by shareholders, not by the traders who ran the scheme. No major bank came close to failure. No trading desk shut down. And the traders? Tom Hayes, a former UBS and Citigroup trader, was convicted in the UK in 2015 and sentenced to 14 years in prison. It was later reduced to 11. He was eventually acquitted on appeal in 2024 after a ruling that the jury had been misdirected about what constituted manipulation under the law. In the United States, the Department of Justice charged 16 individuals. Most of the cases either resulted in acquittals, convictions that were later overturned, or sentences of 1 to 2 years. The financial system fined itself. The traders, the ones whose actual emails said, "Can we have a high Libor today?" mostly walked. Here is the arithmetic of the Libor scandal. Estimated value of the manipulation, $150 to $200 billion redirected from ordinary people, pension funds, and municipalities to bank trading desks. Total fines paid, $9 billion. Senior bank executives who went to prison, 0. The fine was roughly 4.5% of the fraud. That's not a punishment, that's a licensing fee. And Libor itself? It wasn't replaced until 2023, 11 years after the scandal broke. For 11 years after the world's biggest banks admitted they had been fabricating it, the fabricated rate remained the foundation of global finance. The reason nobody went to jail isn't complicated. The people who ran these institutions understood, at the deepest level, that the system wouldn't destroy itself to punish them. The fines were large enough to signal that something bad had happened. They were small enough to be absorbed as a cost of doing business. The Libor scandal is not a story about a few bad traders sending emails. It is a story about what happens when a system decides that certain people are too important to actually punish. The fraud was $200 billion. The fine was $9 billion. Nobody significant went to prison. And the number, recalculated, rebranded, supervised now by new regulators with new oversight mechanisms, is still published every morning in London.